Hello, thank you very much for the kind introduction. Hello, everyone. Um, Let me just choose the application here. All right. Welcome, everyone. Once again, thank you for attending. As the title of the current session says, we are going to talk about the COT, the Commitment of Traders report released by the Commitment Commodity Futures Trading Commission in the US. This will be a session with a very basic approach. That is, if among the users there are more experienced or advanced traders using this information, will be perhaps too basic for them. What we'll cover is we will look at the raw data, and we will classify these data in groups of traders, and we will see several ways to process the data, the raw data that is provided by the CFTC. Um, by looking at the groups of traders that are being reported in through this weekly data, we will also mention what characteristics each of these trader groups have, and what are the threats that are more interesting for us to follow as retail market participants. And last but not the least, or we can even start with it, is to have a look at contrarian opinion, since what we'll be dealing with, or what the COT data tries to convey, is a kind of sentiment of the marketplace, and sentiment is often taken for, or as a contrarian opinions instrument, so to say. And so we'll look at what contrarian opinion is, or what contrarian trading would be, and what it consists of. This is a tricky subject, and perhaps we can also use the COT as an excuse to delve a little bit in contrarian opinion, or in contrarian approaches. Okay, with this, allow me to start here. You are seeing here the official site of the Commodity Futures Trading Commission, where the data is taken from. The CFTC releases the futures and options positions of traders for free each week. This COT information is independent of price data. So especially for currency traders, since I work for a company which is specialized in the spot forex market. In the forex market, we have basically, from a technical point of view, we have only price data. There is um, no centralized marketplace, so that we can gather volume data, for instance. So, but we may use the COT data as a proxy for volume data. But the important it's important to mention that that positions information is independent of price data, and that is not derived from price data, and as such the COT metrics take on a whole new level of importance, because you are dealing here with data, you are processing data that is not derived from price data, so conceptually is not correlated with it. Okay, and by the uh, uh, based on this characteristic, is per se should attract us our interest. Any type of information that we can use that is not derived from price directly. Okay. Obviously, it has some advantages and some disadvantages as well. The data is not very frequent, or nor not to say in real time. This is just data that is released once a week, every Friday, and the data released does not correspond to that Friday in particular, but to the Tuesday of the same week. So this is a kind of lag in the data. This would be, let's say, a disadvantage if we are examining price data, which is real time. But there are ways to work around these advantages and make the information something of useful. Okay, but examining the raw data can be tricky. There is it's just a maze of data, which in itself it's quite difficult to read and understand. We can go here and go to the. I'm looking here to the Chicago Mercantile Exchange futures only short format, where I will find among other contracts. I will look um, for some, you see, you have here some FX related contract. I'm highlighting here the Canadian dollar, and as you see, the raw data is not very user friendly. But this is the data that we will work on, and this is the data that that is produced once a week. Okay. So you see here the data is classified in groups of traders. There is basically non-commercial and commercial traders. I don't know if you can see my cursor while hovering the names, and on the right side you have non-reportable positions, but we'll be mostly focusing on non-commercial and commercials, and try to see what the differences are between these groups. On one side we have the commercials. Commercials are also called hedgers or large hedgers. And these traders have a preference to buying on weakness and selling into strength. That is, they are negative feedback or counter trend trading. They're in fact not trading counter trend, since they are not trading for speculative reasons, but more to hedge risk. So perhaps the term negative feedback would be more appropriate. These groups, the large hedgers, they trade without emotions. They are just hedging risk. They have a long-term view and only change positions when the price deviates a lot from what they consider fair value. Okay. The typical commercial trading pattern, so to say, is to average down in a bearish market, or average up in the case of an uptrending market. And there seems to be an uniform agreement between analysts that the commercials, the hedgers, are the group that determines the direction of prices. Okay, while on the other side would be the small speculator that would be the positive feedback. Okay, the price goes up, I buy. Prices goes even further, so I buy more, and so on. This would be the positive feedback. The negative feedback trading is the price goes down, so I buy. Price goes down, I increase my position, and so on. So we will look into this information plotted on a chart, and you will see how that correlates negatively with the price structure. So we can derive from this that large hedge sentiment is let's say a weak contrary indicator. Okay, I would say weak because of reasons that I will explain later. but this is what most analysts seem to agree with. In using the COT report is when comparing the commercial positioning and non-commercial, the commercial positioning is perhaps a little bit less relevant than the non-commercial, because the majority of commercial, in the case especially of currency trading, is done in the spot market. So any commercial future positions are highly unlikely to give an accurate representation of real market position. But as I said, this is the proxy that we have to work with in order to have some kind of general view of how big players are positioned. Then we have the non-commercials here on the left side, this column. By the way, each group or each group's positions are separated in longs and shorts. Okay, we can see in the column for longs, we can see how many contracts long. In the column for shorts, we can see how many contracts for short, and the same for commercials. We can see the long contracts and the short contracts for the commercials, and also for the non-reportable positions. It's also divided in longs and shorts. Okay, and this is the data that comes out each week, and below you have the difference for each group, and side you have the difference from the week before. Okay, and also the number of traders, and here the open interest that we'll cover in a short. Okay, so as to the non-commercial players, this group is also called the large speculators. So they are a price continuation indicator, or their sentiment is interpreted as a price continuation indicator. Non-commercial data, as opposed to the commercial data, to the hedgers, is more reliable, as it captures traders' positions in a specific market, or speculative positions in a specific market, and they behave more like positive feedback traders. That is, they enter late when the trend is already underway, when the trend is from a technical or fundamental perspective confirm. So they enter into that trend. They suffer through any pullbacks during the trend, and they exit late when their algorithms or arguments or approaches they are using convince them that the trend is over. So this causes them to also to lose heavily at major trend changes, especially when considering they usually have highly leveraged positions. But we should not misunderstand it. This does not mean that they are losers. It's simply that as a group, we are considering a group of traders. As a group, they do poorly if we compare this group with more optimized possibilities that we have as individual traders, for example. Okay, especially when trading with low volumes, or on the retail arena, where we can get easily in and out of the market. So some of these players, they don't have the same flexibility we have as small players in the market to get in and out. So that is why, as a group, they may seem to do poorly if we follow the data week after week. Okay. Nevertheless, these large speculators are associated with superior forecasting ability. Therefore, as a trader, you want to know if they are net long or net short, and at most avoid trading against them. Perhaps we can switch here to a chart where we can see the net positioning. Okay, what I've done here, and perhaps we can switch to the same currency that we were analyzing here, the Canadian dollar. I'm just taking it as an example here. So we see the three groups: the commercials, the non-commercials, and in the green line is for non-reportables. I will zoom a little bit to have just the most recent data here available. Okay, so the zero line in the middle would be where there is no where the net positioning is zero. That means there are an equal amount of long contracts and short contracts. If the line above means they are net long, means there are more long contracts than short contracts, and below means they are net short. Net short or net long means it's the difference between one and the other group. You see between the commercials and non-commercials, you notice this negative correlation. If one goes up, the other goes down. So this has to do with these two different approaches. One is the negative feedback, which are the commercials. If price goes up, they sell, and the positive approach of commercials, the blue line, means the positive feedback trading means that if prices go up, they also buy into that market. Okay, and then we have the green line, the non-reportables that for in this instance are less interesting. These are mainly liquidity traders, and they are usually wrong, as most analysts will agree, and trading against them may result profitable, especially if they reach an historical extreme. It's important also to just as a note, if you are working on the currency market, trends of non-commercial futures traders, of large speculators, tend to follow the trends very well. Okay, we should mention that in the futures market, all foreign currency exchange futures use the US dollar as the base currency. This means that a net short open interest in the futures market for the Swiss franc, for example, shows bullish sentiment for dollar Swiss. In other words, the futures market for the Swiss franc represents futures for Swiss franc quoted in US dollars. Okay, on which long and short positions will be the exact opposite of long short positions on the dollar Swiss as we use it in the spot market. So just that you are aware that sometimes in the spot and futures market, the codes for the symbol for the currency pair changes. The currencies changes positions in what is base and what is quote currency. Okay, just to mention that. So the COT net positioning, that will be the first data you want to find out. Just find out what is the difference between one group or one side and the other, longs and shorts for each group. Okay, for example here, non-commercial, the difference between the longs and shorts. You see here clearly there are more shorts than longs. So this shows that there is a negative net positioning of futures traders in the Canadian dollar. Okay, and this is the most basic information just to that we derive from the COT data. Okay, then obviously we can use the same data and start to see here, for example, let me switch for the Canadian dollar again. We may want to try and we may want to need to plot the exact data that we have, the amount of contracts that we have for longs and shorts on a chart for a particular group. So we may want to have for non-commercials to plot in the evolution of each group. Okay, this may give us an idea if we have a change in the net positioning. This might give us an idea where this change came from. If let me see if we have here correspondence 21. Let me just check here. I need to do some more zoom just to have the latest data here. May. Okay, here. Okay, here for instance, we are here looking to the non-commercial in the net positioning in the COT net positioning. Here is the blue line. Okay, for non-commercials, we see they are becoming less net short, and we may look at what may be causing this ascending move in the net positioning, and we see here that the long side is almost didn't change, but on the short side there the number of contracts is decreasing. Okay, so if the shorts are decreasing their positioning, so the long net figure will obviously ascend. So you can have an ascending net positioning either because of reducing shorts or incrementing longs. Okay, and this may give you another layer of useful information in order to interpret the data. Okay. There is one more data that we can see here in the row format, which is the open interest. I will briefly explain what the open interest is, because sometimes there are people that use the open interest alone without it's by itself a data that a data that you can use. Just allow me here to change we can correlate this with a pair. Okay, with the Canadian dollar. The open interest basically in a futures contract is said that it is open. The contract is open when it has been entered into and not yet liquidated by an offsetting transaction or fulfilled by delivery. These contracts that are open are referred to as open interest. Okay, this is the aggregate of all long open interest, or the aggregate. Let's say the aggregate of all long open interest is equal to the aggregate of all short open interest. Okay, there is always two parts, a buyer and a seller for each contract. This is a concept that is unique to the futures market, and it helps explain the depth of market as well as trade expectations. it is also said that it is the number of contracts outstanding. You may have heard this term, the number of contracts outstanding at at any time in each delivery month, held by the longs or the shorts. It's not the total of both. It's held by the longs or by the short or by the shorts. And so um, it's an excellent tool in estimating the liquidity of a contract. Okay, so is um, so in sometimes we may think or may it may confuse us in thinking in terms of volume. The volume is the number of contracts traded during a certain period in a specific futures market delivery month. It's not the number of contracts outstanding, okay, as the open interest is. One problem is that open interest rises at the beginning and declines at the expiration of each contract market. So this is something that you perhaps want to just to take into consideration. So when open interest is expanding, it confirms that there is interest in the existing trend, and this expansion should be also be accompanied by increasing volume, so to say. Yeah, okay, but here we have two different figures. One thing is volume that you may have or not, depending on the market you are trading. On the spot market, we don't have a centralized volume. We could have volume figures in terms of tick volume in your broker, for example. But in the future market, you have the volume figure. So as for confirmation of the depth of or the strength of a trend, you want to have an expansion in open interest and also increasing volume. So this expansion in both suggests that buyers are creating more new contracts than old contracts. Okay, and when the upward trend continues, but open interest and volume decline, if both decline, then old contract holders are selling and observing new buyers. There is a very schematic way to see when there is an increase in open interest. We have the open interest is this line here, okay, the black line, which is color field here, and the red line with the dots is the performance of the Canadian dollar against, or the US dollar against the Canadian dollar. As for the open interest, okay, an increase in open interest means that a new buyer meets a new seller. If someone comes new to the market and wants to buy, and the new seller comes to the market and wants to sell, the contract between this new buyer and this new seller is an increase in open interest. Okay, there's a new contract. Now, if there is a new buyer, someone gets to the market and wants to buy, and there is another buyer who sells to this new buyer, there is no change in open interest. There is also no change in open interest if an old buyer, someone who already bought, is in the market as a buyer and meets a new seller. Someone comes in as someone which has been on the sidelines until now, comes in and wants to sell, and meets this old buyer, someone who already had bought before. So there is no change in open interest, and a decrease in open interest is when an old buyer meets an old seller. Okay, and when they liquidate or establish the contract between between both, then there is a decrease in open interest. So is one contract less outstanding, so to say. There is a decrease in open interest. Okay. So far, I don't know if there are some. We have more or less half of the session covered. If there are some questions uh, regarding what we said, just feel free to ask.
Currently, there are no questions.
Okay. So we move on. We may now move on to what are the main technical events that we might look when we analyze COT data. And basically there are three very important technical events that we look for. One is flips in market positioning. Flips means when a certain group of traders goes from net long to net short. This in itself is usually an event that is reported in news and in analysis and so on. You may see highlighted when a group which has for a long time been, for example, net short and becomes net long. This is an event by itself and is usually taken as a technical signal or an alert that something is changing in that market. It's in itself, we cannot say it's a trading signal, or as we may understand, a signal like a crossover of a moving average and so on. Is more like a situation or a alarm about a certain configuration of the market picture. We will perhaps make a brief excursion in a minute of what the sentiment reading is and how that is related to contrarian opinion and contrarian thinking, just for us to get familiarized with this idea of using data that does not provide specific trading signals as a sentiment indicator like the COT report. Okay. The other two events that we'll look for are extremes, extreme positioning in one or the other group. If a certain group is positioned historically at an extreme, historically means in relation to its own historic behavior, then we have also an event that is also reported in the news and followed by traders and analysts. You want to know if a certain group, if the mood of that group is touching an extreme. Okay, and then we have the changes in open interest, as we have just seen. Okay, by itself is also a technical event that we might look for. As for sentiment analysis and contrarian opinion, it's worth mentioning that contrarian opinion is not meant to signal a new entry into a position. It only identifies situations that qualify in a certain way. Okay, it thus lacks timing. Okay, especially COT data, which is released on a weekly basis. It's not the data that comes out in a particular week, but more how that data is related to the historical continuum of data that was released for a specific market. Is how it relates to it. It should be read in a relative manner, but it lacks the timing. Okay, and contrarian opinion or contrarian trading also lacks this timing feature to say I will act now, because usually contrary indicators like we have polls, we have put call ratios and so on. All these tools give an idea of how is the mood of the market participants, but it's not an alert in it. It's not a signal in itself. It's more like an alert. Like when we have a divergence, for example, a technical divergence between price and an indicator, or between two price feeds, when it's one is making higher highs and the other is making lower highs. So this kind of situations where we have a divergence is they are more like an alert of they are alerting of the quality of that market, rather than um, printing a trading signal or a buy or sell recommendation. Okay, so COT data can be used more like as a filter than a trading system in itself. Okay, as a means of avoiding risk and finding an opportunity, finding a window where you can trade to guide you in the decision process, which direction should I take my positions right now. You may have a technical approach, for instance, which produces a lot of buy and sell signals every day. And these kind of filters are useful because if your system produces, let's say, the same amount of buy and sell signals, if you have a more or an uncorrelated layer in your decision process, like the COT data, you can decide for each moment if you are going to take longs or shorts the specific market. So you can filter half of the signals your technical approach is producing, especially because technical indicators are designed to produce buy and sell signals. So in order to filter them, you want to have a filter that is not derived from price, but based on a different nature. And this is one very good option, just to be taken as a filter. Is there any question? I just seem to hear the microphone. No. Okay. So it's also interesting to know that when we speak of sentiment in the market or contrarian opinion, is what we are analyzing here is the crowd, is how the crowd is feeling, how the crowd is behaving, and it's also worth knowing that the majority of market players is actually correct most of the time in terms of predicting the direction of the market or assessing the direction of the market. That is not a difficult part of the analysis. If a trend is, we have a full-fledged trend, uptrend, it's not difficult to say this is an uptrend and to be correct, or to say that this trend is most likely to continue up, since it has been up for several weeks or months. So it's not that when we think of the majority, and obviously we want to take a position against that majority, but many times I hear that people think the majority is most of the time wrong, and that is not always the case. For the major part of the time, the majority, the crowd, even the uninformed players are correct about the market direction. It's at the turning points when they get things wrong. It's at the turning points, and to catch those turning points is where sentiment indicators like the COT data come into play, because you have this extreme positioning, you have extremes also in the open interest, you have radical changes in open interest, you have radical flips in the net positioning, and this kind of events are the ones that catch most of the uninformed public out of guard, because they they either don't have the knowledge how to process this data, or simply they don't want to do the work of following data that is not on their price chart or whatever, and miss those turning points. Okay, so there are basically two moments to trade, to be a contrarian. One is to join the crowd, and another to go against it. So be a contrarian is not just to do the to trade against what we think the majority is doing, because most of the time we will be running against a faster train, because the crowd is just too strong to go against it. But we can assess when there is the time to go against it. Okay, and when is the time just to follow the crowd. Okay, there are two moments. So a contrarian approach is not a contrarian per se, but is someone who knows when to go with the crowd and when to go against the crowd. There are these two distinct moments. Okay, so to be a true contrarian and a true analyst of COT data, for example, involves a little bit of study, involves a certain creativity, and also certain experience. Okay, and above all, I would say also patience to wait for those good moments when the majority misses a change in the trend. Okay, just not to borrow you too much here with theoretical things. Let me just plot another study here, another way to use the COT data, and this is a buy-sell ratio. This has been developed by authors such as Breeze, for example. You can find in certain in specialized literature. You'll be able to find to search for COT ratios and look for several ways what formulas to apply to this. Basically, the principle of this way to show the information, and again, we are processing here the same information that we are gathering from the raw data here in the CFTC page. Okay, the same data. We are simply processing it in different ways of looking at it. What we want to find out with the ratio is just to see what is the difference, the proportion between buyers and sellers in a certain group at a certain moment. That is, when you have extreme positionings in one group. Okay, that extreme positioning, the extreme net positioning, okay, in a certain group, is obviously derived from the quantity of contracts, for the quantity of long and short contracts that are positioned in that market. But when time goes by and you have another situation where you have another extreme, you may want to see if that extreme net positioning is also confirmed by a difference between buyers and sellers, a difference between the quantity of buyers and sellers, because in itself this is also useful information. If you have a market, for instance, that is not very deep, it's not very liquid, but the difference between the buyers and sellers is very big, then obviously you have a big imbalance in the supply and demand. You have a lot of more buyers or sellers than the other group. Let's say you have a lot more sellers than buyers, but how much is a lot more? 2 buyers against 4 sellers is twice as much sellers than buyers, right? But we have 2 on one side and 4 on the other. This would be the same proportion as we would 4 and 8, okay, or 8 and 16. But what if we have 1 buyer and 3 sellers? Okay, there are less participants than when counting 4 against 8 or 8 against 16, but the difference between 1 and 3, the ratio, is bigger than between 8 and 16, which is just 1 to 2, and the other is 1 to 3. Okay, so this kind of imbalance between longs and shorts, this gives you also a hint as to what is the quality of a certain positioning figure. What is going inside the market? What is happening in the data from which the net positioning is derived? Is there a big imbalance between buyers and sellers? So this could act as the same way as you do look for divergences, for example, in between an oscillator and price, and you look for higher highs in the indicator and perhaps a confirmation. In that case, would be a confirmation of higher highs also in the oscillator. And if you don't have that confirmation, you have a divergence. So here you could be looking at a certain this kind of situations from a technical perspective. Look here, for instance, we're looking at the non-commercial, the blue line. The blue line here, the net positioning for the Canadian dollar. We have here peaks in February 2011, for example, and we have a peak here in the non-commercial also in September last year, and see how the correspondences in the ratio for that particular group, the blue line again here in the upper widget, and we see that in the first instance, in the first occasion, the ratio between buyers and sellers among the non-commercial group was much more accentuated than in the second instance. Okay, so this extreme here, in terms of the later extreme, in terms of imbalance between buyers and sellers, is less pronounced. Okay, so this is again another way of looking at the same data, exactly the same data, just processed it differently. Okay. So back to the contrarian approach. So it's knowing when to go contrarian that is of utmost importance. So you cannot conclude I'm bearish because everyone else is bullish. That is what I was trying to convey here. It's a way of thinking. So no strategy will have a contrarian mechanism implemented. There is no contrarian an indicator that will provide you a buy or sell signal, so to say. Okay. Okay. There are obviously from a behavioral finance perspective, there are several phenomena that could be of interest to know why such situations happen, where the majority is wrong at certain turning points. This can be related to the fact that we do not accept losses so easily. It may also be associated with an equal valid concept referring to the attachment to a certain opinion. If we when a certain opinion becomes very popular, it starts to become like a dogma, and thinking against a dogma is really something that is difficult for most of us, especially when you see that everyone thinking one way, everyone is writing the same thing or having the same opinion. to have a different opinion is something like, well, it's something that we don't even might talk about it with other people for the fear that that they laugh at us. So this is when you see such kind of situations, then usually there is an extreme situation in terms of sentiment among market players. Okay, so in that sense, a good contrarian should not go against uh, the crowd for its own sake, but should learn to think in reverse, so to say. Find out reasons why that dogma or how that belief the crowd is sustaining may be wrong. And many times markets are just ironic in the way things finally play out. And so we should always try to think, where is the irony here? when everything seems so clear for everyone, where is the irony coming from? Sometimes it's a misunderstanding, sometimes it's just an attachment to an old belief that does not anymore corresponds to reality, and so on. Okay, fine. We are reaching the end of the session, so if there are some questions, please go ahead.
Gonzalo, there are two questions here. The first one is, how big is the lag between the spot market and CFTC report?
Yeah, the lag, that is in terms of time when the data is released. As I said, the data is released on Friday, and it corresponds to the positioning of the Tuesday before, the Tuesday in the same week. Means usually when you see COT reports being released, analysis being done based on the international monetary markets, you will see them being written and published during the weekend or at the beginning of the week. And based on that information, traders take their position for the week. But so the lag would be more or less 1 week between the release data and the new week that starts. Is practically one week. So if there has been a special event like we will have, for instance, this Friday with NFP data coming out, if there is any surprise in the data, if any release or of economical data or any political event or during the week or during the weekend that may alter the perception of market participants, this will make the last reported data probably less reliable, or you may expect that the next week, the next Tuesday, the data will change a lot accordingly to the events that happened. But again, this data will not be published into the Friday of that week. So there is always the lag. But as I said, it's not the data that is important in itself, the data that is released each week, but it's how that data relates to the historical, to its continuum, so to say. And I would suggest, since it is a weekly produced data, you should look at several years or at least months of data to have enough structure from a technical point of view to compare extremes, to compare flips in net positioning, and to cross data ratios with net positionings and net positionings with a dissection of longs and shorts and trends in the total open interest. Think also in terms of a technical analyst. Since this data can be plotted on a chart, you may apply trend lines to it. You may even go further and apply an oscillator to it. And in fact, we can also make an oscillator out of COT data. I'm showing you just here for a moment. Let me just plot here the Canadian again. Sorry. So there are also ways to construct oscillators out of these data. You're just using a formula from the technical world and applying it. This means that if we can build an oscillator, it means we are comparing current data in relation to the highs and lows in a certain historic period. In this case, I'm comparing here 4 years of data, more or less. Okay, so I'm comparing the how we are positioned today in relation to the extremes in the last 4 years, for example. Okay, so in that to answer the question, the data has to be seen in context. Okay.
Okay, and there is one more question. If you could talk about the US GPY in relation to the reports and how to apply to the current market.
The current market, yes. Let us just see here. First we would look to let's see here, to the net positioning. Oh, I can find it here. Japanese yen now. And yeah. Okay. So we see here from without zooming, we see already that both groups here are at very high extremes. Okay. We see commercials net long, obviously they are counter trend, and we see here the non-commercials net short the yen. Okay, and basically at extremes as well. Since we are at extremes, I would be very careful into buying into strengths or acting as a positive feedback trader right now. Means positive feedback would mean to trade on breakouts. I would avoid trading on breakouts to join this trend because the risk is simply too high. Remember what we said earlier, that the COT data allows you also to manage risk. And when you have in a certain market, when you have players positioned at an extreme, you should avoid, perhaps in this case, to act like a feedback trader. So possibly use any pullbacks or any retracements in the price action to trigger also changes in the mass positioning or in the COT data itself, in order to find better spots to enter the market. This alone, from a technical perspective, and only taking into consideration the sentiment as derived from COT. Obviously, we have, in the case of yen, we have correlations to what is happening in the stock markets in Japan. We have to follow also closely the monetary policies of the Bank of Japan. So changes in these areas as well. But from a technical perspective, I would switch now to perhaps buy into the trend that is currently shown in the dollar against the yen, but not at breakouts. Not at breakouts because the risk would be simply too high. You would be buying into a market that already reached an extreme. So I would watch for a better for a better price to enter this market. Or if you are very short term, you may profit from this extreme and try to trade any release of this rally, any corrections of this bigger rally, and trade a short dollar yen for certain for shorter with a shorter time horizon. You may look into several yen pairs, not only yen against the dollar, but you may look to Canadian dollar yen, for example, which from all the yen crosses right now, since the Canadian is a laggard, so to say, it's not doing much against the US dollar. So you have all the moves in the yen. You have them very well expressed in the Canadian against the yen, much better than euro against the yen or pound yen, for example, where it's more lateral the market there. But if you look into Canadian yen, I think short plays are going to be interesting for the coming 1 or 2 weeks.